Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everybody, Adam Bergman here, tax attorney, founder of IRA Financial, and welcome to another episode of AdMail. Today's topic, Roth IRA conversions. So on today's podcast, I'm going to answer 3 questions on topics surrounding the context of Roth IRA conversion. So before I get into the questions, just briefly explain what a Roth IRA conversion is. Well, the Roth IRA conversion simply means that you take a pre-tax retirement account, pre-tax IRA, pre-tax 401k, and then you move it or convert it to a Roth. And by doing that, you're going to pay income tax on the amount of the conversion. And why would you do that? Well, when you pull money out of a traditional or pre-tax IRA after the age of 59 and a half, you're subject to income tax, ordinary income tax. Whereas if you have a Roth IRA, so long as you're over the age of 59 and a half and the Roth IRA has been opened at least 5 years, then all Roth IRA distributions would be tax-free. So there's obviously a major incentive to move assets in a pre-tax IRA to Roth. Although when you do that, there is a toll or a tax that applies to the movement of that pre-tax IRA, whether it's cash or an in-kind asset like stocks or real estate, to Roth, and it's ordinary income tax on the amount converted. Now, there's no 10% early distribution penalty, which is great, but tax is due on the fair market value of the asset you convert. Now, prior to 2009, you were not able to convert or do a Roth IRA conversion if you had income above a certain threshold, which was quite low, it was about $100,000. Why? Because they felt, at least the IRS felt, that they wanted to keep this conversion to more low to medium-sized income taxpayers. Fair enough. What happened? 08, 09, financial crisis. The government needs more money. So they wake up and say, hey, Roth conversions, it's a great way to get more cash because you are getting people to pay tax prematurely, right? If you had a pre-tax IRA, you wouldn't have to pay the tax until you had to take a required minimum distribution, which at that point was like 70 and a half years old. So if you're getting folks to do conversions and pay the tax in their 40s, 50s, or 60s, you just allowed them and you just triggered a premature payment of tax, which will help fill the Treasury coffers. And at that point was super important because the financial crisis obviously had a major impact on the amount of tax collections and revenue that Treasury was going to have to work with. So they did that. They never actually reverted back to the old rules where the income limitations existed. President Biden flirted with that in the Build Back Better bill, and then his 25 budget has a limitation of around $450,000 for Roth conversions. Who knows? I doubt that will ever happen because Roth conversions are just a great source of tax revenue, and especially the Democrats need all kinds of sources of tax revenue to pay for a lot of their social policies. Why would they cut that off? So here's 3 questions that I think open a door jar to a nice discussion on different rules and procedures involved in Roth conversions. First question is from Harry T. And again, before I get into the first question, I only use the first name and the first initial, the last name. So it's pretty anonymous. If you have questions, I'm not going to mention your email or where you're from, or your full name. Send them in. You can send them to info@IRA Financial, or you can leave a comment or question on our social media feed, whether it's YouTube, IRA Financial, Instagram, Facebook, or Meta, Twitter, LinkedIn. Just say AdMail or Ask Adam or question for Adam, and I'll slide you into the queue, and I will get to your question at some point in the near future. So it's a free chance to get a tax attorney to answer a question. Why not? Okay, Harry wants to know, is it too late to do a Roth IRA conversion for 23? Yeah, Roth conversions must be done by December 31 of the year in question. So for 23, December 31, 23. For 24 up until 12/31/24. Once you do a conversion, they're now permanent. Used to be able to walk back a conversion up until the end of the year. That's no longer the case. So you used to be able to kind of pick and choose, be like, hey, I'm going to convert, Bitcoin. And then if Bitcoin kind of tanked, you may be like, I'm going to reverse the conversion. That was fun. We did that a bunch in the past, but they stopped that rule a few years ago. So you have until 12/31 and it's permanent. Second question is from Julio R. Julio wants to know, can I do multiple Roth IRA conversions in a year? Sure. Yeah, there's no limitations. You just pay tax on the conversion. The one thing to keep in mind, Julio, is that there's a new 5-year window for every conversion. So remember I mentioned you have to be 59 and a half and the Roth must be open at least 5 years to take the money out of a Roth IRA tax rate. Every time you do a conversion, it's a new 5-year window. So if you did one in 23, it's 5 years and 59 and a half from that day. If you do one in 24, it's 5 years from that converted amount plus 59 and a half to get the full amount tax-free, including earnings on that amount. So yeah, you can do it anytime you want, but it's a new 5-year window for each conversion amount. Third and final question of today's podcast from Victor R. Victor wants to know, if I do a Roth IRA conversion, a private stock that is not publicly traded, who determines what the value will be? So I've done this, kind of responded to this question in various formats over the years. It's a great question. That's why I think it's important that it's included here. How do you determine the fair market value of a conversion, right? If it's stocks or Bitcoin or gold, there's a publicly traded marketplace. It's very easy to know. Bitcoin's worth 63, Tesla stock's worth 200, or Meta stock's worth 100, so on and so forth, right? It's publicly traded. It's easy to do. Look at close of business day that day, you have your price. And then based off that price, you pay the tax, right? Whatever amount, let's say you own one share of Tesla at $250, that gets added to your income on your 1040. And then when you add all your income in the aggregate, you'll determine how much tax you owe because that will determine your tax bracket. But something that's not publicly traded, like private stock or maybe real estate or a hedge fund interest, private equity interest, venture capital interest, a hard money loan, private business investment, right? A little bit more difficult to value. So for real estate, easier in the sense that there's now a multitude of online sources that you could gather a fairly accurate value. You can also look at tax records, talk to a realtor, get a realtor value letter. You don't have to go and hire Deloitte and Touche to do a $50,000 opinion letter on the value. You don't need to go to that extent, but it needs to be accurate. The IRS still doesn't have to accept your value, right? You may say piece of land A is worth X. They can say, no, we don't think that's accurate. That doesn't seem to happen very often in conversions. I've never experienced that in 25,000 clients, 14 years. Why? Because the IRS, they don't want to dissuade people to do conversions because it's free taxable money. So I've never seen them contest their valuation. Not to say they haven't or would not, but I haven't seen it. Generally, the clients we work with are not going to be egregious, right? If they bought the land for 100K, maybe it's worth 120 or 92 now. They're not going to say it's worth 20 grand or 2 grand, right? They're not going to play games. And if you are going to be super aggressive, you better have very good supporting documentation. Now, if you thought, I don't know, my kid was talking about my kid a few weeks ago about Snap. He uses Snap, the app, and he wants to buy the stock. It's at, I think, $15. But the high in 2021 was like $75. So if you do a conversion at $15 because you think it's going to go higher in the future, that makes sense, right? So it could happen where the price of an asset from a fair market value standpoint has dropped considerably, whether it's a private company, maybe interest rates are really hurting their business model, and maybe you paid 100K for the interest in that private business, and maybe today it's only worth 20 or 30K. That's possible. Just saying you got to have the backup. If, in fact, the company is now worth a lot more because they just signed a contract with Google, then being aggressive on the other end, it's arguing it's worth even less. Maybe that's not the smartest move. So how do you determine value if you have a private company? Well, if you just had a recent raise, a financial raise, then you can use that value, or a recent acquisition, a recent sale, you know the value. If you don't have anything, you can use what you paid for it, or you can talk to the managing member of the company, the president, and say, hey, do you have any valuations? What do you think it's worth? Right? If they don't know, the IRS probably isn't going to know either. So, take that into account. You don't want to be super, super aggressive. You want to be smart. You want to be accurate and fair and reasonable, right? Everyone obviously wants to take a haircut. There's something called a discounted valuation, which a lot of our clients have done. They've worked with various appraisers across the country, and either because of its lack of marketability, a minority discount, right? You own 1% of the company. Maybe you paid $100 for it, but who's going to pay you $100 for that 1%? It's going to be harder to sell. So maybe it's only worth $70 or $60. There's appraisers across the country that have worked in the family limited partnership and now have applied those same principles to private business deals and transactions. So that's all out there. Again, just my opinion is don't be super, super aggressive. Be moderately aggressive, conservative, be fair, and you just want to be able to defend the value, whether it's super, super low or just moderately low or higher or moderately higher. You want to be accurate. Now, should you convert an asset that's gone up 50% or 150% this year? It's your call, right? There's no right or wrong to determine when you should do a conversion. If you think, yeah, Bitcoin went from 23 to 63 this year, but I think it's going to go to 203 next year, then by all means convert it at 63. But if you're like, I think it's going to go back down to 30, then maybe up again to 80, then maybe wait. No one's obviously a fortune teller. No one can predict the future. So you just kind of go with your investment gut. No right or wrong. You obviously would rather pay tax at a low value and then get all that upside tax free, right? Because that's the play in the Roth. You convert at a low value and you shelter all the future gains. In the Roth, you wait till you're 59 and a half. Roth's been open 5 years. Shebang. Everything you pull out is tax free. That is the game. That is the way you can Peter Thiel your Roth IRA and turn $2,000 into $5 billion. Not sure we can get all that way, but you can turn several thousands into several hundred thousands, maybe even millions. If you get lucky, make some good investments and convert at the right value. So thank you, Victor. Thank you, Julio. Thank you, Harry. Hope everyone enjoyed today's podcast. Great question. So again, keep them coming. If you have questions, I'd love to hear from all of you guys. You can send them to info@IRA Financial, to say AdMail or Ask Adam. You can hit us up on social media or just leave a comment. Otherwise, hope you enjoyed the podcast. If you're watching on YouTube, thank you. And don't forget to subscribe. We generally post 3 podcasts: AdMail, AdBits, Adam Talks, and 3 to 4 videos a week, including a YouTube live, 1 or 2 a week. So if you're interested in awesome self-directed retirement content, this is the best place to be in the world on the internet. I don't think anyone knows this stuff better than me as a tax lawyer, someone with a master's in tax law, someone that's written 8 books on self-directed retirement topics. This is my passion, and I hope I'm able to inspire and educate more and more people every day to understand that the tax code is literally rigged in our favor. Alternative assets are allowed. Excuse me. And if you know how to play the rules, you could become a tax-free millionaire. Not that difficultly, whether it's just understanding compound returns, understanding the investment rules, understanding conversion rules, taking advantage of the retirement system to work it to our favor is not only doable, it's easy. You just need to understand the rules, and that is what I do. So thanks again. Have a great day. And I'll see everyone again next week. Thanks.